Hello and welcome to my discussion on preparing a statement of cash flows using the direct method by utilizing a spreadsheet. All of the discussions we've had on cash flows to date come into play. You figure out the change in cash by putting it on one side of the equation and solving for the change in all the other accounts on the other. And the spreadsheet does that so perfectly that I'm excited to show it to you. First of all, let's notice what we have to work with. Oops. We're doing a cash flow statement for the year 2013, and we have a balance sheet for 2013 and 2012. We can use that to figure out the differences between the balance sheet accounts, the change in the accounts. We have an income statement for just 2013. As you'll recall, income statement accounts start the period with zero balances. So the change in the account is simply the balance in the account. And we also have some additional information. When you prepare a statement of cash flows for a business, you would really have a general ledger where you could look up the facts of transactions. But when you're doing one out of a textbook, you must be given those facts since you don't have a general ledger. So we'll be referring to the additional information just once, I think, when we do the operating statement, but several times from that point on. And notice we have facts A through H. Here's some instructions for preparing this statement of cash flows. Using the direct method on a spreadsheet, the first thing we need to do is prepare cash flows from operations, and we'll do that in our first video. And then we're going to do investing and financing activities in a separate video. Usually takes quite a bit of time to do cash flows from operating activities, so we don't want to get it too long. Now let's take a quick look at the spreadsheet we'll be using. I brought over some amounts. I brought over the information from 2012 on the balance sheet, put it in the first column, and 2013 and put it in the second column. And notice my total assets equal my total liabilities and stockholders' equity. And then I also brought over the income statement amounts, just straight from the income statement. I'm showing revenues positive and expenses as negative numbers since they reduce revenues down to net income, and then net income I brought straight over as well, 37. And from this information, we're going to make the statement of cash flows. We'll post journal entries to look at the effects of cash on transactions, and we'll show the change in the accounts above this line, and then anything below this line will be where we'll put the change in cash. And in this way, we'll start building the statement of cash flows. Now, when you do the statement of cash flows, the income statement pretty much drives what you're going to do on this statement of cash flows. Let's go back to our problem data for a moment. Requirement number 1 says prepare a statement or prepare a spreadsheet for preparation of the statement of cash flows using the direct method. Then it gives you a little detail on how to do that. I'll just remind you, it says use the income statement and the changes in current assets and liabilities to complete the cash flow from operating activities section, and that you should refer to additional information as needed. Once we've figured out the change on the income statement accounts and the current assets and liabilities, we'll go through and check for completeness. I'll be sure and point that out when I'm doing that with you. And then we'll finish up this first section by calculating the net cash flows from operating activities. So, let's get started. Notice that I'm just letting the income statement drive this first part. I'm going to use numbers to link transactions together, so in case we get lost, we can go to a number and see what transaction didn't balance. So I'll start with the number 1. Sales revenue. Sales revenue has a credit balance, so I'll show that with a credit. Now you know from previous discussions that accounts receivable also changes with sales revenue. Notice ours went from a debit of 48 down to a debit of 24. Accounts receivable went down by 24. So I will go ahead and enter that in. So I have a debit of 24, or I have a credit of 24 and a credit of 210. So I need a debit of 234 to make my worksheet balance, and that is how much cash I have received from customers. So I'll come over here and write cash from customers, and that finishes my first line on this worksheet. Notice that my journal entries total, and they should, and that my cash flows from customers is I collected all of my sales and another $24 out of accounts receivable. And I know that because it went down. I guess this would be a good point to say, please notice that we're rounding in thousands. So we're using the income statement to drive this. So the next item on the income statement is dividend revenue. It's $4. Revenues have a credit balance, so I'll enter the 4. That was the change in that account. Now I'll quickly look up here and see, oh, I do have dividends receivable. So I know that that would change with this. It went from 3 to 4. So dividends receivable increased. I will put a 2 to hang these two accounts together and add $1 into the debit column because a debit of 3 plus 1 more equals 4. On my worksheet, I now show that I had $4 of dividend revenue, but I only received 3 of it because 1 is still in dividends receivable. Now I can write cash received from dividends for the entry that will make this balance. 4 minus 1 is 3. 4 was the first part of our entry. 1 was the second, so now we balance, and look, I check at the end of this journal entry, and I see that I'm in balance. I see that I'm out of balance. I said 3, but I typed 4. Now I'm in balance. See how well that works? Anytime that you do something like that, you're not in balance, so you just need to remember to check after each journal entry. Back to the income statement. The next item on my income statement is cost of goods sold, and I'm on my third journal entry. Now these journal entries, don't get confused, don't get made anywhere except on this worksheet, and the only purpose of making them is to see what the change in account balances effect is on cash. So cost of goods sold has a debit balance, so I'll record that right from my income statement. And you'll know from previous discussions that inventory and accounts payable change with that. Inventory went from 30, inventory right here, went from 30 to 35. So inventory increased, so I'll put a debit there for inventory going out. I'll put a 3 here to show I'm working on the same journal entry. So I had some cost of goods sold, and I put 5 more on my shelf. What happened in accounts payable? Accounts payable went from 18 to 14. It went down. Accounts payable has a credit balance. To bring it down, I need to put a 4 there, and that shows that. I'll put my 3 in to show I'm on the third journal entry. So inventory 5, cost of goods sold 125, accounts payable 4. They're all debits, so I'll add them together. 125 plus 5 is 130, plus 4 more is 134. Cash paid to suppliers is the sum of those 3 things. I need a credit to make this balance. I'm on transaction 3, and I put in 134. Notice my journal entry still balances. What does it mean? I paid for all of my currently sold inventory, cost of goods sold. I put $5 more worth on the shelf. and I paid down accounts payable by 4. So there's the logic of it. Let's move on to our fourth transaction. Our fourth transaction, salaries expense. It's 27. So I'll record that because it's a debit. Salaries expense has a debit balance. So salaries expense changed over the period by 27. Now I'll check to see if I have any salaries payable, and look, I do. Salaries payable went from 4 to 1, so I need to show that as a debit of 3, and that is from transaction number 4. So I paid for all of my salaries expense of 27, and I paid an additional 3 down on the salaries I owed from last year. So cash paid to employees is the sum of those two. Salaries payable went down 3. Salaries expense went up 27. 27 and 3 is 30. So cash paid to employees is the sum of those two. Credit is what I need to make that balance. 27 and 3 is 30. So you can see one at a time I'm going through and I'm seeing how account balances changed. And I'm doing the income statement with current assets and liabilities because they usually travel together. Income statement's driving this. Depreciation expenses 4. I'm on transaction 5. Depreciation expense has a debit of 4. And you know that depreciation expense, the credit for that wouldn't be cash. It would be into accumulated depreciation. So I'll go ahead and record that. That was a non-cash transaction. The next item on my income statement is $6 interest expense. So I'll put a 6 here and record the 6. And I need to, lots of 6's, find interest payable, see if there's one, and it went from 3 to 5, so it got bigger. It got bigger by 2, so I'll put the 2 there. That's part of this transaction. And we're on item number 6. Now I'm going to check to see if I have any discounts or premiums on bonds, because that affects interest too. And look, I have a discount on bonds payable. When interest changes, discounts on bonds payable changes with it. It went down. The discount has a debit balance of 2, and it ends with a debit balance of 1, so it must have been credited for 1. I don't see any more premiums or discounts, so I think we're ready to see the cash implication is. Interest payable changed by 2. It went up, so I didn't pay all of my interest expense. Bonds discounts went down by 1. That also affects it. I have a 2 and a 1 on this side of the journal entry, and on this side I have a 6. So I must need 3 more to make it balance, and you can tell that by looking down at my totals. Let's see, 2 and 1, and so 2 and 1 is 3, or I'm sorry, interest expense is 6, and interest payable is 2 and 1, so I need cash paid for interest of 6. I'll record that as an outflow. So the effect on cash from all of that for transaction 6 is 3. Now I notice I'm out of balance. I know the last transaction I was in balance, and the one before that was I must have messed up the last one. I can tell because I'm not in balance. See, that was depreciation. Depreciation was 4, and oh look, whoops, I put 5 there because it was number 5. Oh, let me fix that. See, I'm showing you that I like the worksheet because it constantly tells you when you do silly things. Let's keep going and not do more silly things. A loss on the sale of building will be transaction number 7, and a loss is a debit of 1 because losses have debit balances. you're not going to be able to get the information you need from looking at accounts because we're going to need to know the facts of that transaction. Let's go back to our additional data. So, item A says a building right here that originally cost $24,000 and was 3/4 depreciated. 3/4 at 24,000 is 18,000 was sold for 5,000. Let's go ahead and record that on our worksheet. So we're on transaction number 7, and the building accounts, it says, are going down by 24,000, and it's 2/3 depreciated. So we said that was 18. So I need to enter my 18 and my item number 7. And it says I received cash, and that's from investing activities, a sale of another asset. Buildings aren't current, so I better drop down and record this. I need to record it now to stay in balance, even though we're somewhat out of order on that. Oops, wrong row, huh? Get rid of that. Come over here, we're on transaction 7. And we got $5,000 cash for it. So let's see what happened. 18 accumulated depreciation, loss of 1. It's 19. Cash 5 is 24. I'm building an equipment 24. And once again back in balance. Great. Let's move on to transaction number 8. Transaction number 8 is for 14, income tax expense. So I'll record the 14 there, and I'll look for an income tax payable. Is there one? Yes, income tax payable has gone down by 1. That's a debit. So I'll put there, and I'm still on transaction number 8. So if income taxes is 14, and I paid another 1 besides that, cash paid for income taxes must be 15. Cash paid for income tax 15. So I'll come over here and show that as an outflow on item 8. Still in balance 451, and I'm done. I'm down just to net income. Now this entry isn't as intuitive. You know that net income gets closed into retained earnings, so I'll go ahead and come up here and on transaction 9, put net income of 37 into retained earnings, and I have to do something with it down here. So we're going to assume on transaction 9 that that net income comes in our worksheet right here, because we need a debit for that, and it keeps it in balance. Now if you look, you can see I can total my cash flow from operating activities right now. It'll be 210 plus 4 minus these expenses. So if you look, I have made a formula that does that. It takes 39 and 44, 39 and 44, and subtracts these expenses from it, and it nets to a cash flow. Cash flow from operating activities is 55. I've just made the worksheet do this for me automatically, so I already have the cash flow from operating activities done. So everything below this line is cash flows. So this is the cash effect that net income, the changes in net income and the related balance sheet accounts had on my operating activities. It's the change in the cash accounts from looking at those accounts. Thanks for joining me as we complete this section on operating activities. Join me for section 2 where we'll do investing and financing. Bye for now.